Welcome to our weekly Chartsarefun session. This is Abhijit and Ron Singh, recording this for the week of December 9th. Well, the market keeps climbing. There was pullback, but not too far from the all-time highs. Yes, in particular, there has been over the last couple of weeks in December, reasonably solid pullback in the small caps. Pullback quite a bit, and this has led to the oscillator. We look at the oscillator pulling back to an oversold level. So, in preparation for the Santa Claus rally. Typically, this happens the last 10 days or so in the December when the market does start rallying. We'll look at what happens next week. I think it is setting up for a Santa Claus rally ahead. We'll look at some targets that the market should be meeting. But that said, there is quite a bit of optimism kind of coming in with respect to the put call ratios and overall complacency in the market. The investment manager complacency in terms of bullishness is at almost close to the July highs. So we should be cautious into January. I think right now, market has got some upside. We'll look at where the targets are for small caps, IWM, the Russell 2000 ETF. We'll look at the S&P 500, and we'll look at Bitcoin. It's interesting where we think Bitcoin could be headed in the next few weeks. And then I will point out a little bit of concern on the 10-year Treasury yield that has been climbing, and that led to the small caps pulling back. As we know, small caps are extremely interest rate sensitive. So we'll look at that. But there is a possibility, and there's a strong possibility, that if the economic data continues to be hot, which we found out this week, there was both CPI and PPI. CPI came in just as expected. PPI was slightly hotter than expected. So if market starts seeing hotter data, you could end up having a hawkish Fed. We know that Chair Powell and the Fed has been fairly supportive of the market. There has been expectations for cuts in 2025, but that can slowly wither away if the data keeps coming hot. So with that, let's just share charts and look at the market. So this is our blog site. The charts are fun at substack.com. We appreciate you, listening, kind of subscribing to our blogs. Just share your email. When the blogs come out, you'll get it right in the first thing in the morning when it comes out. Our YouTube site is also Charts Are Fun. We appreciate you subscribing to this channel. Both are free of charge. And then if you like the videos, we hugely appreciate you liking the videos. Today, I'm going to start a little bit about where we think the 10-year yield is telling us, because as we say, and as the market says, the bond market usually is smarter in terms of where smart money's conjecture or thoughts are about the market. This, in some ways, is a bit of kind of breakout pattern that is shaping up in the sense of an inverse head and shoulder. We can see that a neckline is around the 45 level or 4.5%. There was a left shoulder here from 44.79 to 41 up to 44.9. Then we got the head from there to 3.6 or 36 back to the 45 level, pull back again to similar levels of 41. And now we're getting some upside. If 10-year yield breaks 45, the measured target is from 36 to 45 is 9 points. Add 9 to 45, that's 5.4%. We know that the interest rates were, as in the Fed funds rate, was in the 5.25 to the 5.5. From there, we've had a 50 basis point cut in September and then followed with another cut of 25 basis point. Market is expecting another 25 in December. Good chance that the Fed won't disappoint since they would likely signal of a pause or, not having to do a cut, but there's a good chance we'll get it. But from there, we should be cautious of any cuts in 2025 whatsoever. And if the 10-year yield breaks 4.5, I don't think the market is going to like it as much. You could say that this yield breakout is more of an economic strength breakout, but that said, there are interest rate sensitive stocks in the small caps because they need to raise capital to run their businesses. So that would impact the small caps. And overall, we know that the dollar is strengthening. And as the 10-year yield breaks out, you can expect the dollar to strengthen more. And that's going to hit the larger companies that sell a lot to the international markets, because the US products will then be more expensive, and it's going to really hit hard on the the exporters in particular in the US side. So that's something we are watching. This is potentially an inverse head and shoulder. As I'm talking about, we would not want the 10-year yield to break 4.5 or 45. Now, it's a possibility, like we've seen here over several weeks, it could be hovering in that 4.5 to 4.1 level, and maybe that's possible, causing us the Santa Claus rally. But if 10-year yield breaks 4.5, I would be getting very concerned on where the market would be. Now, I talked about the oscillator. This is the NYSE oscillator. There's also an equivalent oscillator on the NASDAQ. The NYSE, we can clearly see, is pulled back from a level at the overbought level at 45 to an oversold level near minus 56. We've seen in the past, like early November before the election results, we had an oversold level at minus 62, and at a lower low in the August 5th, remember the Japanese stock market crash level. And then this was kind of towards the late May. But the minus 62 on the top, it can go up to 60, or it can be as extreme as what we saw in the mid-July to an 85. So this is oversold, where we can expect a rebound in the oscillator, which could mean a rebound in particular the small cap stocks. IWM has an ascending triangle pattern. This is the Russell 2000 ETF. We have a resistance level at 227, higher lows. That's where the ascending term comes from, is from the ascending lows. That breakout from 196 to 227 is of the order of 31 points. At 31 to 227, that's 258. That's the target. Yes, we hit 243, 244 twice from their pullback. I was expecting this to be a shallower pullback in terms of a cup and handle, but this pullback a little too deep, broke below the 20-day moving average, and just about came close to testing the 50-day moving average. Why is this a bullish looking chart? The 20 is above the 50, which is bullish, and they're both climbing. If the 50 is actually turning lower, then that's not any longer a bullish chart. But if the 50 is climbing, it tends up to being a strong support and tends to help the market rebound every time it tests it. So we see that it has come close to testing it. It was in the level of 236, and it tested the 50 is around 229, just a little below 230. It came close to testing 231.88. So I wouldn't be surprised to see a small cap rebound next week. Now, we know that the Fed rate decision is there next week, middle of next week. It's possibility of any kind of dovishness from the Fed, not being overly ambitious about stopping the rate cuts next year. They could still be saying that we'll be data dependent, giving market the cut that it wants, could set up the spirits for a holiday rally. And we know that, the consumers have been strong. Holiday season could kind of continue good retail spending, and we could effectively see a rebound in the small caps. And that's something for us to look into. S&P 500 has a cup and handle target on its daily chart. We see a beautiful cup from 56.69 to 51.19. That's 550 points. Add 550 points to 56.69, we get a 62.19. That's where the target comes from. We can see that as S&P is climbing, RSI is not getting any strong from what we saw in the July timeframe. So that's a bit of a negative divergence. And we can also see that PPO is kind of in the point like 82.9 in that level. It's kind of flatlining. So momentum in this sense of RSI and PPO kind of flatlining indicates momentum is slowing down. So 60 to 19 isn't that far. We are, at 60.51. You're talking about another 160-point rally. It's a possibility in the end of December Santa Claus rally we could get it. But once 60 to 19 is reached, I would start getting cautious on further upside in the market. Finally, I'll talk about crypto. Bitcoin, we know post-halving always has a massive rally. This is the halving from 2016 into 2017, a solid climb, parabolic climb in the post-halving. Then again, the post-halving climb from 2020 into 2021. We just got a cup and a handle. This cup and a handle, by the way, measures to a target at 132,000. So from bottom of the cup around 15,500 to 73.8, take that difference of the depth of the cup, add it to the top of the cup brim, 73.8, that measures to 132. We've crossed 100, by the way. So we have crossed the 100 threshold. We've been hovering. We had sharply pulled back after crossing the 100 to 104 and then pulling back. But that was the high of the month at 104. The low was at 91, little below 92, 91,000. So we could continue the climb into next few weeks, and that 132 could come in faster than we can imagine. So the inauguration is mid-January, momentum into that. It's almost like, you know, buy the rumor, sell the news kind of an event. Right now, there's huge optimism about a pro-growth, a pro-economy president. He won the Time of the Year award, was at New York Stock Exchange, really very optimistic about the economy. He also talked about crypto with Jim Cramer's interview and so on. So that momentum could help the cryptos climb further. We know right now it's not just Bitcoin, other altcoins are also climbing. And so that momentum could help climb. And we've seen that consecutive candles of climb happens after that post-halving breakout period, right? So you can see here a cup, a handle, and then the breakout. Similar kind of a cup, a bit of a handle, and then a breakout. Same pattern here, a cup, a handle for a few months, and now this breakout. So we could expect that momentum to continue and additional upside on Bitcoin, which means the ETFs, whether it's Fidelity's ETF FBTC, the Grayscale GBTC. Of course, the poster child here is MicroStrategy. They have very aggressively invested in Bitcoins and leveraged instruments around Bitcoin. Twice X kind of movements are being done by the maestro, the founder of Michael Saylor of MicroStrategy. So those are a bit riskier, but there are safer way to invest in it with, as I said, the ETFs, the direct ETFs, GBTC, FBTC, IBIT, and so on. So in summary, setting up for a oversold breakout, we can see that the oscillator from 45 has pulled back to 56, minus 56. As the oscillator rebounds, we can see that the MACD on that is also kind of oversold, has pulled back quite a bit below the zero line. So as the MACD rebounds, we could get a market, rally higher. We have a target at 258 on IWM, the small cap ETF. So from the 230s, low 230s to 258 is definitely a possibility. You're talking about close to 28 points or so in here, so which is a solid, talking about 21, 22, sorry, a 10%, 10 to 11% rally left in here. And S&P from the 6,050 level to 6219, another 160 points or so can be expected in the S&P. And Bitcoin could, continue to climb, and we could hit target near 132,000 in the next several weeks. Good luck investing. Let's see what the Fed does next week, and we'll talk to you at the end of next week. Thank you so much.